If you've ever watched a real estate video, you've probably heard someone say, it's a great deal. But what does that actually mean? Because behind every great deal, there's a set of numbers. And the people who consistently win in real estate aren't guessing, they're evaluating. That's the difference. They're not emotional about the house. They're asking one question. Do the numbers make sense for this market and this strategy? Because the deal that works as a flip may be terrible as a rental. A rental that cash flows in one cycle may underperform in another. So before anything else, you need to understand how investors actually look at opportunities. The first thing they look at is margin. How much room is there between what they're buying for and what the strategy can realistically produce? If it's a flip, that means purchase price plus renovation, plus folding costs, plus selling costs, compared against realistic resale value. Not optimistic value, realistic value. That spread is everything, because thin deals break when the market shifts. The second thing they look at is risk, and this is where market cycles matter again. In a strong expansion cycle, you can sometimes survive thinner margins. Inventory moves faster, buyers are active, confidence is high, but in contraction, risk goes up, days on markets stretch, price cuts happen, buyers hesitate, and that same thin margin can disappear fast. That's why professionals adjust their buy box to the cycle. The third thing they look at is strategy fit. This is huge, because the same property can be a wholesale, a flip, a rental, a creative finance opportunity, even a note play, depending on the numbers. The property doesn't determine the deal. The strategy does. That's one of the biggest mindset shifts in real estate. Great investors aren't attached to one outcome. They ask, what is this property best suited for right now? That's where real deal making starts. The fourth thing they evaluate is time horizon. How quickly does this deal need to produce? A wholesaler wants speed. A flipper wants a short execution window. A rental investor may accept slower returns because they're optimizing for long-term wealth. So time changes what good means. The fifth thing is exit options. That's what newer investors miss. Professionals ask, if plan A doesn't work, what's plan B? Can it still cash flow as a rental? Can it be assigned? Can terms solve the problem? The more exits a property has, the safer the opportunity becomes. That's how experienced investors think. They're not buying a house, they're buying optionality. And this is why two investors can look at the same property and see completely different opportunities. One sees a flip, one sees a rental, one sees a creative finance play, one sees a wholesale assignment. Same property, different lens. That's what makes deal structure so powerful. So here's the real takeaway. A great deal isn't about the property. It's about margin, cycle, strategy fit, timeline, and exit options. When those align, the deal works. When they don't, the property becomes expensive education. That's why Seminar Insider focuses so heavily on frameworks instead of hype. Because once you understand how the math and the structure work, you stop chasing random opportunities. You start seeing the real leverage in the deal. And in the next video, I'm going to break down how investors actually use creative finance and deal structuring to create opportunities, even when the numbers don't work traditionally. That's where things get really interesting.